This episode, as with all episodes, exists thanks to the supporters of the show who contribute a mere $3 per month via patreon.com/copytradersclub. Thanks for listening, and thanks for your support. Copy Traders Club, where you can learn how to make better decisions and more money copy trading. I'm Gavin Macaulay, my name and username on eToro. Today we talk to a PI who offers something very different from the norm. Is he a PI who can make money in any market? Let's find out. Here we go. Season 2, Episode 33 of the Copytraders Club podcast, and as always, my aim as an eToro enthusiast is to demystify this new and uncharted world of copy trading, understand what are the pitfalls and best practices, and how ultimately to succeed as a copy trader. In chats like today's, the aim is to answer all your questions about this popular investor, and reveal more about them than anywhere else, so you can assess whether they might suit you. In this episode, we talk to Antonio Nobile, one of the few PIs who's making profits today and is building a record that is attracting considerable copier attention. So let's give this half-Italian, half-English gentleman our attention. Antonio, ciao, benvenuto nel Copytraders Club.
Buongiorno Gavin, come va?
Tutto bene, tutto bene.
Bene.
Well, I know you know that in order to get past security and into the VIP section here, you've got to answer a series of quick-fire questions. Pronto?
Andiamo.
Username on eToro.
Antonio Nobile C.
Date you joined eToro.
March 2017.
Date you became a popular investor.
That would be April 2022.
Year of birth.
1994.
Place of residence.
UK.
Profession.
Trader.
Briefly state what you aim to achieve on eToro.
I suppose it'd be to beat the market over time and compound my returns over the next however many years, forever.
Name one of your investing heroes.
Let's go with Jesse Livermore.
Name one of your favorite investing books.
I would say the Incerto series by Nassim Taleb.
That completes the formalities. Let's proceed now into the VIP section here at the Copy Traders Clubhouse. Antonio Nobile, aka Antonio Nobile C, are you ready for this magical transition?
I am. Let's go.
Okay, here we are in the Copy Traders Lounge, Antonio. It's exciting to have you here.
Likewise.
So you take a seat. Can I get you a little drink, little glass of Chianti or something?
Why not? Why not? As long as you join me with a glass.
Absolutely. Toe to toe. So as we discussed just before we started recording, I was kind of expecting you to be an Italian guy who was currently living in the UK, but you're a tad more English sounding than that.
Yeah, that catches a lot of people off guard. I'm half English, half Italian. So my mum's English and my father's Italian. And I was born in England, but I move a lot. So I've lived all my life going backwards and forwards quite a bit.
And you told me that you're in Warwickshire. Is that correct?
I am, yes.
And do you spend much time in Italy?
I do. I'd say I spend almost half of my time in Italy.
And linguistically, you're also 50-50 down the line.
Literally half and half. Like my friends say, you're half and half because you're neither Italian nor English. In terms of the language, I speak both perfectly. But in terms of how people think or perceive me. They think when I'm in England, they think I'm Italian, and when I'm in Italy, they think I'm English, which is quite funny.
And your surname Nobile means noble.
It does. Although I assure you, I come from the most humble backgrounds, particularly on my Italian side.
That was going to be my next question. Are you from Italian nobility?
No, definitely not. It's actually interesting. So once I looked up on the surnames dictionary, the surname Nobile, and it turns out it's the surname of the town in Sicily where my family's from.
Okay, so you're not descended from gentlemen of Verona?
No, definitely not.
I also read somewhere that you said that your family have long been involved in the travel industry. In what capacity?
Yeah. So my family, we have a small tour operator. It's a family business. My parents started it and have always run it. And we have a farmhouse villa in Tuscany with some rentals units. So I grew up in the travel business. The tour business is walking tours. So I run walking tours in Italy and in England. And then when I joined, I opened up Spain. So we started to do some tours in Spain and Corsica in France. So yeah, I grew up in the travel industry.
Very good. And I also saw somewhere else a while back, and I tried to then gather more information on this immediately prior to the chat, but I couldn't find it again, that you used to work for some company that makes luxury speedboats. Is that correct?
That would be my wife's family business. They make speedboats, luxury speedboats. And we've been involved, both of us have been involved with both of the family businesses over the last few years.
Is that an Italian business or an English one?
That's an Italian business. That's an Italian business based in Italy.
So your wife's Italian?
She is, 100%.
And these are like luxury speedboats that there wouldn't be anything as vulgar as fiberglass involved. It's all beautiful wood and navy shiny surfaces and not too much space given over to people to lie out and get suntans. They're real classy sort of boats.
So if you ask my wife's father, he says they're like a Porsche. You should be able to go out shopping with it, but at the same time, it's a fast car or fast boat. So they are made of fiberglass. The hull is all made of fiberglass, but you'll have teak and other woods for the details.
They're the kind of boats that, you know, a 60-year-old Italian man with his young trophy wife speeding around.
Indeed.
What do you call that part of Italy with the steep cliffs?
In the Cinque Terre or in the Amalfi Coast.
Yeah, Amalfi Coast. That's what I was
Coast.
thinking of. That's what I picture.
Yeah. Well, they're not based too far. They're not based too far from there.
Will that be you in a few years?
I don't know. Maybe.
Except not with a trophy wife, with your current...
with my wife.
Darling. Okay, so how did I come across you, Antonio? The first time I heard of you, I think, was because of your participation and commentary on Felix Falak's videos.
Okay.
And I've been watching you since. We'll talk more about that a little later. In fact, we've got loads to talk about, so let's get through this getting to know you bit a little quicker than we normally do. So let's skip to tell us something you're very bad at.
Concentrating on things I'm not particularly interested in.
And how does that manifest itself in life? Other than losing track of this conversation.
No. This is a good conversation. Well, it's, I don't know, it's a trait where I can just hyper-focus on things I'm super interested in, and I'll be terribly distracted on things I'm not particularly interested in. My mind sort of goes in many directions unless I'm super honed in on one thing.
Okay, Antonio, let's get on with the serious matter and have a look at your profile. If I could ask you to read from your bio, from the word strategy to the word outlook.
Dynamic long-short portfolio. I trade across asset classes, not just equities. For context, I look at the very big picture, cycles and super cycles, and then zoom in and evaluate the macro environment based on multiple data factors, cross-market analysis to determine which assets, sectors, countries to be long and which to be short. Tracking monetary and fiscal policy also comes into play. Understanding the psychology of the market, sentiment, put-call ratios, positioning, fear and greed, breadth, etc. TA and evaluation of volume and volatility at different prices give me entry and exits to the trades I want to put on based on my outlook.
Okay, let's pick apart a couple of those things. First of all, long-short portfolio. Very quickly, what is that?
It basically means I'm quite agnostic at how I look at any asset class, and I will either be long or short it based on my current view. And I will tend to have longs and shorts as opposed to having exclusively one direction or the other. I'll try and balance it out.
Okay, can you please explain the sentence that begins with the word understanding? Understanding the psychology of the market and sentiment comes next. Okay, that's fine. Break down the next few things. Put/call ratios.
So I think psychology obviously plays a huge role in markets because we're investors, we're animals, as Keynes might have said, and we make decisions based on our emotions. And so understanding how other actors are behaving and how they're positioned can either make you understand whether you're on a, with consensus, against consensus, whether a move might be overextended in one way or the other. And so put call ratios is obviously related to options, whether people are buying more puts or calls. Positioning, so you're talking about things like CFTC gives you futures and options positions all together, but you can look at it from other ways as well. Fear and greed is just a fun.
Let me stop you there. F and G means fear and greed. I didn't know what that was. I was looking up what can F and G mean. F and G investing, Investopedia, F and G. This is a term I've never heard before.
It's because there's the
fear and greed. I thought it was some polysyllabic term that I'd never come across.
It's nothing fancy. It's because there's the word limit to the bio, and so you have to try and cram it all in. But it's, again, you never look at any of these indicators to make a decision based on any single one. The Fear and Greed Index is something that CNN puts out and they calculate, and it's quite fun, I think, and interesting to see whether, according to them, you have extreme bearishness or extreme bullishness, or extreme fear and extreme greed.
And finally, breadth.
Breadth is sort of looking at within the indexes, how many stocks are up, how many stocks are down. I mean, I look at breadth very broadly in the sense that even on a sector level, how many sectors are rising, which ones are declining, even or you can look at it on a global scale, how many countries and how many stock markets are appreciating, how many are depreciating, or up, down. Keep it simple.
Yeah, the reason I focused in on that sentence is because, the average copier might not know what all this stuff is in your bio, and you're a macro guy. You're all about a lot of these areas of investing that are shrouded in technical jargon. So I think it can be quite important for people to understand exactly what you mean by these terms.
Yeah, it takes time. I mean, it took me years to figure them out and understand them myself, and I'm still have a long way to go, I dare say. I write a lot, and in my articles, if you read them enough over time, I explain them and try to break them down as simply as possible. So I think followers and copiers will also learn a lot of those things by even just following me, even if they don't copy me.
Will you mention over the years? Let's look at your performance on eToro over the years.
Okay.
Okay, so you've been on eToro since March 2017.
Mm-hmm.
It looks like 2017 was a fun year. You're messing around. You ended up with 532%. We're not going to focus on that too much. By the same token, 2018, you're down almost 80%. So if we're going to gloss over the first, we'll have to gloss over the second.
I think anybody can guess what was going on in those first 2 years. Doesn't take much imagination.
No, but to make it obvious, you're going to say the word.
It would obviously be crypto and Bitcoin.
Okay, and you were having some fun then. Let's keep going through the years. I'll give the annual results for the next subsequent few years. 2019, almost 13%. 2020, 161%. 2021, 114%. And 2022, year to date, over 16.5%. Now, that whole picture makes me ask the question, when did you start getting serious?
I would say 2019 is definitely when I started to get more serious. And again, still, starting to get serious doesn't mean you figured it out. And so still in 2019 and 2020, I made a number of mistakes, I suppose, things you learn along the way. But 2019 was when I really started to get serious.
And from your pinned post, which was written 6 months ago, you said, "Finally, I've been accepted to the PI program." Why finally?
Well, it was a bit of a long haul for me to become a PI. Anybody who's been following me for a while will know this. So the rules have now changed whereby you can have a risk score which can actually max 7 but have a lower average. But it was not like that. Previously, I had to have a max risk score of 6 and a lower average. Becoming a PI had always been in the back of my mind, but I never really seriously started to try and become one until later in 2021. I wanted to, get better before I had that pressure on me. And when I did, I was struggling to get my max, because of my trading style, below 7. Previously, my risk score was higher, but from most of 2021, I had an average of 5 and a max of 7. You can't become a PI like that. And then you have to have 6 months where you have a risk score below max 7, so at 6 within their parameters, before you were accepted onto the scheme. So from September 2021 until February 2022, I was, within the risk score, max 6. I couldn't become a PI. Then to become a PI, you actually have to have copies, and I was copy blocked. So then there was a month where I just could have a few copies, and that maxed out within like the first day. And also for 1 month, I was stuck with copies but not being a PI. And then April 2022, I became a PI. And then, I don't know, June this year, they decided to change the rules and make it max risk score 7. So I could have done that a year ago for me. But anyway, it is what it is.
Yeah, because you're not the average kind of PI. You're very different from most of the people that I've spoken to on Copytraders Club, which is why I'm very excited to have this conversation, and we're going to keep it moving along because we've still got a lot to talk about.
Yep.
So let's quickly run through these things. Risk score. I always ask everyone, do they think their risk score is fair? But let me quote from you here. "I do not have a target risk score. Many of you already know how I think about risk. Basically, there are times when you can take more risk and times when you should take less." You go on to say, "Ideally, I will be trying to keep the average in the 3 to 4 range, but don't be surprised if occasionally for a few days I ramp up the heat."
Yeah, I think that still reflects. I probably should edit and say the average is probably going to be more like 4 to 5 as opposed to 3 to 4. 4. Ideally, I'd like to keep the risk at an average of 4 and a max of 6. But there are occasions when I'm comfortable taking it up a degree. Going back to what we were saying a minute ago, one of the things I don't understand about them changing the risk rules is in a year where you can have, when there's higher volatility, so investing in general is more risky, you're raising the risk score limit, as opposed to in a year when volatility is lower and so it's less risky, you have a lower risk max which PIs can take. I look at it the opposite in a sense. You sort of want to be doing it in the inverse.
Okay, copier numbers and assets under copy. Now, your copier numbers. If someone did a blind test on me and showed me a record since 2017, which includes triple-digit returns in 2020 and 2021, and a 2022 year-to-date of 16-odd%, heading for a fourth consecutive year in profit, and asked me to estimate copier numbers. I would have said we're talking 3,000 or somewhere like that. So I was quite surprised when I scrolled down to see the number was 773. That's not a number to be sniffed at. But why do you think you don't have thousands? Is it because you've only really been a PI for a few short months?
So it's a combination of factors. I've only been a PI for 6 months now. So in theory, next month I should become an elite PI, seen as I meet all the requirements. I met them the first day I became a champion. I already met those requirements. But in also another part is I've not been featured. So I know one of the rules eToro has is they do not feature PIs who have extremely high returns in their feature page, because it might give the wrong idea that those returns are sustainable over time. And so because of how their algorithm works, I don't appear on the feature page as opposed to a lot of other PIs who do. And I think that makes a huge difference.
Yeah, you're just too good, Antonio.
I don't know. We'll see. It's a long way to go, yes.
Okay, assets under copy. It says here between 2 and 5 million. Can you give us a more precise figure?
Yeah, it'd be 2.8 at the moment.
And as you just mentioned, my next question was going to be, why are you not an elite?
In theory, I should become elite next month because I've now been champion for 4 months. So I've received 4 monthly payments as champion. I already met the requirements to become elite already when I was a cadet, I believe. So in theory, next month I should become elite.
So you've done the CC level 3, or you already have that equivalent qualification? Which was it?
The CISI level 3, wealth management.
You did that through eToro?
I did. That was a funny, there's a backstory there, whereby back in December, sort of around Christmas, I thought, let me try and get the CFA, so the Chartered Financial Analyst certification. And the exam was in April. So I thought, okay, I'll sign up for this. I can do this. Yeah, 3 months to study for the CFA is not enough. Yeah, it's a huge, huge, huge curriculum. And at the same time, we were just entering a bear market. So, I was trying to become a PI. So that I didn't have the time. It was either focus on surviving the market and doing well. So I decided to postpone my CFA. And then as I was becoming a PI and I knew I was about to, I was in contact with my account manager at the time. I said, well, let me get as I've studied for this, I'm sure the requirement that eToro has, their exam is similar. It must match some of their. And so I did a mock exam online and I passed it straight away. So I thought, okay, let me sign up for an exam next week. And so I think I did the exam for the CISI 2 weeks later. But obviously I'd spent 3 months studying for the CFA. So a lot of stuff overlapped.
So you aced it straight off?
Again, I think a lot of stuff overlapped. But yeah, it was relatively straightforward after the studying for the CFA.
Good stuff. Okay, we're going to talk about communication, but I've got a section of the conversation later where we go over some of your tweets.
Okay.
But in terms of communication, I see in your pin post you say the following: I have ideas on how to build this community over time, not just the usual boring old video everyone does on YouTube. So I'm excited to hear what those ideas are.
I suppose I hadn't read that post in a while. I suppose instead of doing the boring old videos on YouTube, I'm doing a boring old newsletter. No. I think one of the things on my page, which I work a lot at, is the posts. And at the time, I didn't have any structure to the posts. I was just posting a lot. And now I've added a lot of structure so people know what to expect on a weekly basis, even on eToro, where I post, so, they know I'm going to write every Monday morning. They'll get a weekly macro note, and then they'll know at least every other week there'll be like a I look at some data, and then I usually discuss my portfolio and what I'm doing, sometimes more often than others. So it's adding structure to my page, and so people know what to expect, when to expect, and how to interact, I suppose.
Okay, let's close out this little bit with a little aside. I feel obliged to tell you that you look very much like my long-term business partner
Right.
physically. I imagine you're very tall. Are you like 6'4" and above?
Six. No, I'm six. Oh, in meters, I'm 186. So what's that?
6'1", just over 6'1". Okay, you're only a little over 6'1". Oh,
Yeah.
you're short arse. I didn't realize that.
It depends. You see, in Italy, that's not very short. In England, it's not particularly tall. In Italy, it's not particularly short.
And the other thing that I'm wondering, do you have in common with him is, are you a vegan? Because you've got a big long neck like him and you're very slim looking and a strong jawline.
Definitely not. I everything.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Okay, Antonio, let's turn our attention now to your portfolio. If I can just describe your asset class allocation to the listener. Indices, almost 46%. Stocks, 36.5%. ETFs, 17.5%. Now you have 27 positions. You said earlier you're long short. More short than long, it has to be said at the moment.
I am, although I'm considerably less short than I was 2 weeks ago. So I'm currently, as it stands, I believe I'm about 33% net short, as opposed to a week ago where I was probably about 70% net short, and 2 weeks ago I was probably 100% net short. The portfolio changes quite often.
Yes, you're very active. And just to spell it out to the listener, you short indices, you short individual stocks. You're the most short PI I've ever spoken to on this podcast. Your outlook is more bearish, I think it's fair to say, than anyone I've spoken to. Most PIs aren't terribly bearish, or even if they are bearish, their portfolios don't necessarily reflect that. Would that be fair to say?
Yeah, I think I probably am amongst the most bearish at the moment anyway.
But it does seem like things are almost becoming unavoidably bearish. But we'll get into that later. For now, here's another quote from your pinned post. I keep track of economic developments across the world as best as possible. Not the narratives, the data. That's what you say. Now, when I talk to some of the more bullish PIs, like recently we had Ugo Manonti on, and next week, Robert Merck, I would say they're among the more bullish PIs. They also say, ignore the narratives, look at the data. So everyone's looking at the data and drawing very different conclusions. Now, there's a song by Simon and Garfunkel,
Okay.
jumper wearing harmonious duo from before your time and before my time as well, to be fair. And one of their songs includes the line, all lies and jest, still a man hears what he wants to hear and disregards the rest. Link in the show notes. So, Antonio Nobile, how can you ensure you're seeing what the data is showing and not disregarding those elements of it that run counter to your stance?
You know, you say Simon and the Garfunkel, isn't Hello Darkness, My Old Friend theirs as well?
Well, let's leave the darkness aside.
So, data's and numbers. There's never, I don't think at any point, all data points in one single direction. Although I would say that very rarely do so many things point in a direction as they do now, which in my opinion is quite a bearish one. I think I'm even more bearish now compared to where I would have been even at the start of the year. So I turned quite negative at the start of the year, but didn't realize how much more negative I should have been. I look at it in various different levels, and at the most basic level, I think liquidity is the most important thing. If you study history, study previous bubbles, you see that the expansion of liquidity via either the monetary base or credit, because you've come up with a new way of creating credit, etc., has driven both economic growth and consequently often markets or market bubbles, or become market bubbles. And coming into this year, we'd come through one of the periods when more liquidity had been put into the system than ever before, i.e. post-COVID. And now we're going into one of the periods where liquidity is being withdrawn from the system at the fastest pace, and not only in one country, but globally, because the US withdrawing liquidity, raising rates, shrinking their balance sheet, literally forces every other country in the world to basically do the same, unless, their currencies, they want to devalue their currencies, but seeing as inflation's an issue now globally, on a level which hasn't been an issue for 40 years, if their currencies lose value compared to the dollar, which is, the global trading currencies, they're going to have even higher inflation still. And so it's forcing everybody to remove liquidity. And that's just not good for asset classes historically.
Okay, two things I want to say about that. We mentioned earlier your returns in the last couple of years. When everything was roaring, you were making triple-digit returns. Mm-hmm. This year, everything's changed, and you're in double-digit positive returns this year, so you're not a perma bear. Could you be that rarest of things, a PI who makes money in different market circumstances?
I think I can be quite annoyingly bearish and quite annoyingly bullish. My feed was quite different in 2021, whereby you had those pretty much on a 4 or 5 week basis, you had those dips where everybody was panicking and the market was down 5-10%. And I was extremely bullish in those moments when everybody was quite fearful. And now it's very much the opposite. Ironically, those dips time coincided with option expiries. And you'd have these volatility spikes and markets dropping, and then it'll pick up again. And now it's the inverse is happening on the downside, where when you go into option expiry, not every time, but this year, but on a lot of occasions, you've had the market rally due to those dynamics going on in the option market. So that's interesting, I suppose. But the point is, I can go both long, short. I can be bearish and bullish. I'm not going to be bearish forever, I hope. Things will get better, inevitably.
Okay, well, let's talk about the indicators, because no matter what indicators there are people who see white and people who see black, be it inflation data, employment numbers, consumer spending, the housing market, even the words that the Fed says. At the moment, it seems there are those who see everything as a thumbs up and those who see everything as a thumbs down. So let me ask you a question this way. What data do you see that runs counter to your overall view and gives you the most reason to reconsider your position? What's the hardest for you to explain away?
The hardest for me to explain away right now? Well, that's a difficult question because there are a lot of things which are slowing in quite a dramatic way. I think one of the things which I'm not concerned about, which I have in the back of my mind, is the fact that inflation is peaking or has peaked, and I expect it to come down over the next 12 months. So inflation peaking is a function of the economic slowdown we're going through, and at the same time, it's a function of the comparisons compared to last year. By the time we get to June of 2023, you're comparing against the 9% or 8% inflation of this year. So obviously, there's going to be a slowdown. And I think that people may take that on a positive note, although I don't think that would last. I think that will, economic reality is much more serious and will trump that narrative, which ultimately is another narrative, I suppose.
I think I saw in a tweet of yours where you said that buy and hold was not going to be the way forward when it comes to investing. I think I know where you're coming from with that, at least in the short and medium term. So let me try and articulate that, and you tell me whether this is what you had in mind. We've all been trained to buy and hold. Buy at the margin of safety. The Fed will play the game and keep things going along, and in the long run we'll all be fine. You know, the Fed put, as they call it.
Mm-hmm.
In 2018, at the first sign of pressure from the market, Powell pivoted, and we all expect the same again. However, it is different this time because inflation is such a problem and the debt is so bloated now that he literally can't take his foot off the gas. So the Fed's going to keep hiking higher and longer than people realize, and possibly more than is necessary, even at the cost of a deeper recession than anyone wants. Maybe Jeremy Siegel would say the same. So things are not going to revert to okay for quite a long time. So buy and hold investors could be bag holding for years and years before stock prices ever return to the prices at which they were purchased, i.e. during a long since popped asset bubble.
Yeah, I think you've summarized it probably better than I could have. But no, you've hit a lot of
Get in there.
you've hit a lot of nails right on the. You've hit a lot of spots there. For about 30 odd years, 40 years, inflation's been coming down. Interest rates have been coming down. Liquidity's been entering the system, and that's inflated asset prices. And even more so, that's happened over the last 20 years, and even more so over the last 15 years with rates at zero and quantitative easing infinity. And it's just lulled investors into thinking that it's easy. You just buy, you hold, things go up. And I think history shows that there are moments in time when that is not true. And there are moments in time where your investments could, some companies, even if they're good companies, their stocks could decline, 60, 70% and stay down or chop in a range for a number of years. And so in real terms, you're actually losing money, even if, say, in nominal terms, you're flat over 10 years. So you never know what's coming. This doesn't necessarily have to come to be. But I think with inflation where it is, there is a high possibility that interest rates are going to have to be higher for longer. And that just creates a very, very different investing environment.
By that, do you mean we're all simply slaves to monetary policy these days?
It's sad how dependent we've become on the Fed, actually. It's kind of crazy. I struggle with that a lot because it's just nuts if you think about it. The balance sheet of the Fed is, I want to say 50 odd % of the US economy. The balance sheet of the ECB is 110% of the European economy. These numbers are rough numbers. I'm firing off the top of my head. The Bank of Japan is 160% of their economy and owns, what percentage of Japanese ETFs. So they're inevitably a bigger part than they ever were before. So unfortunately we are. Going back to what you were saying, are still stuck in the Fed put idea, and they think that he's going to flinch. And they're starting now to realize that that's not necessarily the case because he can't. The Fed has been extremely clear that they know that this is going to cause a slowdown in the economy. They're very aware of that. And in fact, it's what they're aiming for. From a historical point of view, they seem to have learned the lesson of the 70s, or they want to portray that they have, i.e. that they're going to be aggressive here at the start to try and make sure that inflation doesn't get entrenched, because historically, once it does get entrenched, it's harder to resolve. Whether they'll be able to do that or not, I don't know. I have my doubts. I think there's a very high risk that even if inflation does come down simply because of the economic slowdown and comparisons over the next 12 to 18 months, I think as soon as activity starts to pick up again, it's very likely that inflation just starts to trend higher again and stays at a higher level for the next few years or foreseeable future anyway. And it means, an interesting thing to follow up on that is structurally the way the market is structured. The last 30 odd years have made passive a very, very big part of the market, through their 401ks or people just buying every month. And even this year, we've seen flows into equities are still positive. People are not taking money out. People are still following that passive buy and hold. And I wonder if that may not be so much the case again, or whether that may not work as well as it has.
Okay, that's a question I have to ask you about how you short. The difference between shorting indices and shorting stocks, individual stocks. I saw this theory recently. We live in an environment where massive money flows into index-linked ETFs. And while passive investors are still following what they've been taught all along to buy the dips, money keeps flowing into these ETFs and the biggest components of them. So stocks like Apple, Microsoft, Google, etc., which are keeping the indices and those stocks up. And until passive investors get spooked and stop buying the dips or start selling, these main indices are not going to see the same drops as the broader market or as other elements of the market. Does that sound right to you?
Yeah, it makes sense to a degree. I've noted often this year that I judge Apple and Tesla to be the bellwethers of the market or of the indices because everybody owns Apple, from Buffett to your grandmother in her pension fund or to the Swiss National Bank owns Apple. And Tesla is your most speculative stock, loved by retailers out there. And they're big components of the index. Apple's 10%, I think, of the Nasdaq or something like that. So that makes sense. If you look at how this bear market started and how it's evolved, in a way, you could date it back to the end of Q1 of 2021, where your most speculative small cap stocks, let's say ARK or IWM, peaked and declined all the way through 2021, while the indices continued to rise. So they were the first to be hit, and these flows are not so important there as they are in SPYs or Qs. And you can see now Apple and Tesla are still relatively high compared to many other stocks. And they're the most loved, and they'll be the last to go. Inevitably, they'll be the last shoe to drop, I suppose you could say.
Okay, so let's talk about the philosophy of shorting individual stocks. To my mind, it takes a lot of balls to short. So perhaps you have more than the average person. Now, hold on. More balls than to find a good business that you look at and you think, well, it's a great business. It's underpriced. It should see a rise in stock price over time. That's the game that most of us play. Is your process for identifying individual shorts simply the reverse of that? Find a not so great business that's overpriced that should see a drop in stock price over time? Or do you need much more specific circumstances and a shorter timeline in order to have the confidence to short an individual stock?
Running a portfolio the way I do is probably a lot more complicated than the way a lot of people run their portfolio. You sort of buy and cross your fingers, I suppose. When it comes to shorting, the indices are slightly easier, even though you're fighting against those passive flows, because you're not likely to get squeezed in the same way you might do with a single stock. So I suppose the first thing is you don't want to go all in short on anything. You want to have a bunch of different shorts in different places and a bunch of different longs on the other side, so that if you are wrong on one short, it's not going to kill you. And the reasons are multiple. You generally start within a sector. So am I bearish on this sector or not? Are there reasons why I think tech or retail or discretionary is going to decline? And then within there, I'll look for the most overpriced, or the ones where I think the slowdown might be greatest, or where the decline in their revenues might be faster. And then at the same time, some technical elements will play in. So has this broken down yet as a trend on a very simple level? My technical analysis, I keep it as simple as possible. But has it entered a trend which is breaking down? Is it likely to do that? So various different considerations.
Okay, you said a minute ago that Tesla and Apple are going to be the last to drop because of all the support they get. But Tesla is your biggest individual short position. So if you don't think that's likely to drop significantly anytime soon? Talk us through your rationale there.
No, I think it is now at the point where it's likely to drop. People are going to listen to this and, okay, let me short Tesla now because Antonio. No. But I do think the probability is skewed against Tesla at this moment. And I think the retail trader is getting weaker and weaker. Those speculative flows in something like Tesla are going to be less likely to be so strong against me, I suppose.
But haven't you heard? EV sales are rocketing. The Shanghai factory's back online. Musk says he's done selling Tesla stock. They're driving down the price of batteries. Hertz has just bought 100,000 Teslas. Full self-driving is improving all the time. The junk bond rating will soon be in the past, meaning massive money inflows. Plus, of course, the robo-taxis, the bot, solar, Tesla homes, etc. It's going to be the biggest company in the world, Antonio. What's your problem?
Maybe, or maybe I don't believe Elon quite as much as everybody else does. I have my doubts to a number of those things. Tesla's from a valuation point of view, it's ridiculous. And I'm not a valuation guy. Like, valuation is not a reason to be long or short, but it's silly to the point where Tesla's valued more than all the other car companies in the world put together.
What do you mean valuation is not a reason to be long or short?
Well, because valuation is historically not been a good, it doesn't seem to me anyway. I think there's some research which backs it. Valuation is not a good way to decide whether you should be long or short something. You'd be better off understanding whether their revenues, their margins are accelerating or declining, or whether they're accelerating at a slower or faster rate to decide, because something might be overvalued, but for the next 2 years, the rate of their revenues is going to increase at a faster and faster pace. And so maybe it's not, you probably want to still be long it because there's a reason it's overvalued. It'll probably still continue to get even more so. So valuation in and of its own is not sufficient a reason. On its simplest level, we're in a huge speculative bubble which has popped, and Tesla is the speculative asset per excellence. And I don't think that we are going to be at the end of this decline until Tesla has also declined.
Good time for me to ask this question then. Let me quote from your pinned post once more. I'm not tied to any single asset. I live by the dictum that I couldn't give a fuck about any ticker. So, can you see any circumstances in the future where you would buy Tesla?
Yeah, of course. If we get to, in 12 months' time, I think the economy's finished slowing, the market decline is over, and the trucks are real, the Cybertruck is real, maybe the robots are real, and maybe the robo-taxi actually works, then yeah, sure, why not? There's no reason not to. But as it stands, I have doubts on a number of those things.
Okay, let's talk about your sources of information. You say you look at the data, but I imagine you also consume a lot of commentary.
Yeah.
Other people's newsletters, YouTube channels, podcasts, things like that. Tell us some of your main sources of information.
So I would say there's one in particular which I've learned a lot from over the last 12 months. I think I've been a subscriber, and that's called Hedgeye. It's Hedgeye Risk Management.
What's it called again? Hedgeye.
Hedgeye. Hedgeye. I've learned a lot from those guys over the last 12 months. They've got a very good macro process, and they've helped me learn a lot. Other than that, there's a lot of sources. I wouldn't know what else to point to in particular.
Can I suggest a name and see if it strikes a chord with you?
Sure.
Because I suspect it might. Because I've been watching a lot of their stuff recently, and then I've been reading your newsletters, and I'm thinking, there's no way Antonio doesn't watch this YouTube channel. And it's called Wealthy On.
No, okay, I know of Wealthy On, but I don't really watch it. I've seen a few interviews of a couple of people, but I don't really follow Wealthy On very much, I must admit. Over time, I watch less and less. The more time goes on, the more I sort of watch less of other people. I filtered down really to a handful of sources, and I'm getting better at dissecting the data myself. Done a lot of work on that point of view. So, yeah.
Okay, then let's talk about some of your individual positions. We mentioned you're short Tesla. You're also short some luxury brands when I looked on your portfolio. Louis Vuitton, Moet Hennessy, and there's another luxury brand here, Burberry. And was there another one? Montclair, is that another luxury brand? Or?
Mm-hmm. It is, yeah.
So, shouldn't they hold up better during times of economic downturn? The theory you hear is that luxury brands are where the rich people spend their money, and you know those rich people, they have enough money to keep spending once all the rest of us mere mortals stop. So, some people, including PIs on eToro, are buying up these luxury brands right now, yet you are shorting them. Explain that.
Well, the rich are going to be just as affected as everybody else because they're in assets more so than anybody else. And so when assets decline, they're going to be equally affected. And even if they could still potentially afford them, psychologically they're less inclined probably to buy them. And I also think a lot of these companies have benefited in the post-COVID boom, whereby even those who couldn't afford, it depends on couldn't afford is relative, but people were shooting way above, punching above their, what's the sentence? Punching above their weight line or the
punching above their weight.
The
well, people sitting at home during lockdown drinking Moet champagne, watching Netflix,
and buying these things. And now, obviously, inflation is eating away at people's budgets, so they cannot afford to buy these things anymore. So I just expect there to be a decline in what these companies are able to sell, in the amount of buyers that are out there. And also they have high inventories at the moment, which they're going to have to get rid of over the next few years into a slowing economy with less people able to afford them, and the rich probably even less inclined to afford them. The rich, they own 90% of assets. So if assets decline, they're impacted just as much as everybody else.
Okay, so it strikes me we haven't really described to the listener what your portfolio looks like that much. So I'm just going to run through some of the headline assets here in terms of the amount invested. So you start off with the shorting of the NASDAQ, and then there's a bond ETF, IEF, which is short-term bonds, not short-term, what length of period, 7 to 10 year. Then we have a short of the S&P 500, a short of Tesla, a short of the FTSE 100, then shorting Louis Vuitton, as we've just mentioned, then a buy position on long-term treasury bonds, shorting Apple, shorting Burberry, buying Activision Blizzard, buying gold. Let's stop there. That just paints a little bit of a picture.
Do you want me to run through that?
Just generally, we're going to get to at least one of them later.
I'll go through generally, and then if there's anything specific you want to ask me a question on, go ahead. So the index shorts are obviously reflect my general bearish macro view. Some of the stock shorts we already discussed. The bond long and the gold long are the other side of the coin. They're not necessarily going to work. They're not necessarily right, but there is a possibility. So going back to what we were discussing earlier, where I think inflation is peaking and inflation is going to come down over the next 12 months. So even if I expect the Fed to remain tight, I think the bonds, which have sold off at a historic level this year in a historic way, I think there's a potential for them to appreciate. So that's the other side of the coin to my shorts, in a sense. And I think if that happens, there's a possibility for gold as well. May or may not be.
Won't the bonds come into their own when the Fed pivot ultimately happens?
Well, usually bonds, they move before the Fed. So the Fed is your lagging indicator there. They started to move up. The rates started to rise long before the Fed started to tighten. So your Fed is your lagging indicator there. So we're playing a game of front-running the Fed.
And I saw in one of your recent newsletters, when you talk of lagging indicators, the Fed is acting upon lagging indicators.
Yeah, well, the two mandates that the Fed has, which is full employment and price stability, are lagging indicators. So inflation and employment are the last things to change in terms of rate of change in the economy. So there will be things which change sooner. Consumer your sentiment, retail sales, those will start to slow a lot sooner, while inflation will be the last thing to rise and peak and come down. And the same goes for employment. If we just look now, so many economic indicators have slowed, but employment has remained historically, at least in the US, although we're seeing a slowing there from the employment point of view, but employment is still strong. So they're acting upon lagging indicators.
If they're acting upon lagging indicators, that means that their thought processes are not based on what's going on the ground. Do you think that means it's inevitable, therefore, that they will overdo it?
You know, you could argue that they're already overdoing it because the economy is slowing anyway. You could say, you know, at this point, just wait and see because you have no clue. None of us have a clue. We're all speculating here, and they're speculating as much as everybody. And you're in a point which the system is extremely, extremely fragile, and anything can break at any moment. And any one thing breaking can cause a lot of things to break. And they risk, in my opinion, breaking stuff. And then the other side becomes even harder. If I were them, I'd just be waiting and watching right now because it's not a given that raising rates, especially where they're raising them, with inflation at 8 and rates at 4, that's not what's going to make a difference. Historically, you have to take rates above inflation. So if you're not prepared to go up above 8 now, or 6, 7, for obvious reasons, then let's just wait.
But they're not going to wait, are they? Because their whole raison d'etre is being called into question, and they have to preserve their own purpose for existing.
People think they're not a political institution, but they are. They're a very political institution, and inflation is the number one issue in America, or generally globally has been for a number of quarters now, and so they have a political pressure on them to deal with it. And also, I don't know how many governments can afford to fund themselves with the levels of debt they have today if rates move a lot higher. So even if they risk breaking things, I think they have to get inflation down ASAP in their minds anyway.
Okay, that brings us back to gold. Let's speculate on gold for a second. Another one of your tweets. Where to put your money these days, you keep asking yourself, and your mind keeps going back to gold. Now, some learned voices are suggesting that the Fed even easing off on rate hikes, which is going to happen at some stage, will be a huge bullish signal for gold and silver. And the extreme bullish case is that it's tied to something you just mentioned. It's that inflation is making the cost of servicing national US debt too hot to handle, which may force the Fed to acknowledge that their hands are tied in trying to reduce inflation sufficiently through rate hikes. And then if there's increased talk in the US political arena about the huge cost of servicing enormous debt, the printing presses may have to come out again, devaluing the currency and adding to an environment where precious metals could make a hyperbolic rally. Where do you stand on all of that?
I stand that I don't know. Honestly, it could, higher rates and liquidity coming out of the system, obviously, it's not good for gold. But gold is an asset which we've had for thousands of years. And it's worked historically in times of this idea of the 70s and gold, rallying throughout all of the 70s. Now, we don't know, or I don't know anyway, whether that was just another speculative thing of the moment, whether there are actually reasons for that or not. And we don't know whether that's going to happen again. For sure, I think gold will be the first to move when there is a pivot before stocks will, because it benefits from a declining dollar and liquidity going in. So I think it will be one of the first to move, also because even when the Fed pivots, we're not going to be out of the rough yet from an economic point of view. So people may still be looking for that security of the safe asset, and it's perceived to be the safe asset. Bitcoin's not the safe asset. Gold is the safe asset historically. The only other thing I would say is silver's gold with a little bit of leverage on it, in the sense that it will tend to do what gold does, even though silver's probably more of a commodity than gold, which is more of a precious, it's an asset.
You don't own any silver, do you? On eToro? No.
Not at the moment. I've been considering going long gold and short silver on the other side, but at the moment, no.
Okay, let's go through some more of these tweets then, quite quickly, I think, because, we've been talking for quite a long time about the meat and bones of the issue over the last 20 minutes or so. Okay, you like to poke fun at Elliott Wave guys, seeing them as one of the best contra indicators around. Explain, please.
I'm not an Elliott Wave theorist, I should say. I think they take their technical analysis a little bit too seriously, to the point where it's borderline astrology. And I've just noticed over the last few years, there's these Elliott Wave guys on Twitter who were bearish all of 2021 and are now bullish and have been bullish all of 2022 because of their structures. And it just cracks me up that you can be so stubborn and so adamant about being wrong and not only but being perma bear or perma bull, but you've been bearish all of 2020 and 2021 and now you're bullish. That's quite funny.
Okay, speaking of technical analysis, cycles, etc., I wonder where you think we are in the classic psychology of a market cycle. That graph that everyone shows?
Yeah.
The euphoria has certainly passed. I think you would say the complacency of a bear market rally has come and gone.
Mm-hmm.
July. And now we're somewhere on the downslope where anxiety, denial, and panic exist, somewhere before capitulation. Where would you plant your flag?
We've obviously gone through the denial. I think we're somewhere beyond, somewhere sort of anxiety. What's after anxiety?
Anxiety is above denial, which is above panic, which is above capitulation.
We're somewhere, we're past the denial. So we're probably in the close to panic stage, but we're not there yet. And I don't know whether it'll happen on this leg down or we need another rally to. I don't think this is going to get resolved quickly. I think 2023 is going to be another tough year. And I think there's considerably more downside if you think that the S&P is still, 25% from its all-time high. The panic may soon set in. Volatility is picking up quite a bit at the moment. But whether that happens between now and the end of the year or sometime in early next year, where you have capitulation, I don't think we're at capitulation yet. So we're approaching panic, but we're definitely not at capitulation. And I think what's going to follow capitulation is frustration for a long time. I think that's going to be, I don't know if it's on the chat, but there's going to be, after capitulation, there's going to be frustration for a very long time.
Those are cheery words. Speaking of which, another one of your tweets is you say you have to constantly fight your own biases. Are you currently biased towards things definitely being no bueno?
For sure. Yeah, and it's something. So I am, and you fight against it in the sense that 3 weeks ago I was almost 100% net short. Now I'm 30%. Okay, because we just had a 10% decline in just over 2 trading weeks. Do I want to take a step back? Be a little bit less exposed in case there is a bounce back, or in case maybe I'm wrong. Maybe the Fed does pivot at the next meeting. It's unlikely, they're not going to, but you just want to make sure that you're not overexposed all the time. It goes back to what we were saying at the beginning, whereby there are moments when you can put your foot on the pedal and there are moments when you should take it back. And I'm getting to a moment where I want to be short, but not overly short, because volatility cuts both ways, especially when it rises so much.
Do you think that might define your behavior for the foreseeable future?
Yeah, I think realistically, we're going to be in a bear market, quote unquote bear market, all the way into 2023 at some point, probably sometime after the first half of 2023. And it's not going to be a straight down. There will be 10, 15% rallies along the way. but there's considerable more downside to come, in my opinion. But you've got to be careful about it. So, for example, July, we had quite a rally in July, and I would expect to have similar kind of moments where people think we've bottomed and they're all ready to buy in, and they all start chasing, and then again you go back in from that to panic again. And the level of panic will move up and up as we move down and as we step our way down.
Okay, Antonio, let's pivot now. After all that talk of pivoting and not pivoting and the macro environment and the Fed, let us pivot to copiers. Switching back to eToro. After all said and done, who should copy, Antonio?
Well, anyone, I suppose. Anybody who wants to be exposed to a macro portfolio, so a portfolio which tries to make the most of the changing environments, the changing macro environment, and it's constantly changing and it constantly will change.
Yeah, I prefaced this earlier in the conversation, Antonio. Are you that rarest of things, a PI who can make money in varying market conditions? You've proven in recent years you can make incredible returns in bull markets. You're making very good returns in this market, which I think you and I agree is a bear market. So are you what copiers are looking for, I wonder? And is your quite humble number of 700 and whatever it is copiers going to multiply in the month ahead? I suspect it might.
I plan on being on eToro for the foreseeable future and building my business around being a PI. So people can expect me to continue to do what I'm doing. I just hope to get better over time. I don't think I'm nowhere near where I want to be in terms of how good I am at this. So I hope to keep on getting better and doing well in all environments. Inevitably, any investor is going to have ups and downs, but I hope to do well overall as we go forward.
Well, if you keep doing so, they will definitely flock towards you. Which begs the question, who shouldn't copy, Antonio?
Oh, well, I suppose anybody who wants me to sugarcoat things and sell them a nice, happy story, I'm not the place to go. Unfortunately, I'll give you the hard truth, whether it's good or bad. Sometimes I'll be positive and bullish, and other times I won't be. But hard reality, at least the way I perceive it.
Well, one thing we have spoken about a little off microphone is whether you are in some ways exactly what copiers are looking for. It's very difficult, I think, to be, say, a long-term buy and hold value investor on eToro, even if you feel deep in your core that that's the best way to go about investing. As a PI on eToro, everything is colored slightly differently. Your job really is to appeal to copiers and to keep copiers happy on an ongoing basis, which is very difficult if you're a buy and hold investor who might see nothing in terms of tangible returns for 2 years. Copiers don't judge you over a 10, 15-year time horizon. Do you think your approach is tailor-made for being an eToro popular investor? And is that why you invest the way you do? Or is this just you?
I would say it's a combination of the two. So it's how I invest in the sense that I've always tried to have a big picture view, a macro view, understand what is going on a big picture level, and then narrow it down more and more to specific investable ideas. The way I trade on eToro is inevitably being influenced by becoming a PI, A, because of the eToro rules, and B, because of, I suppose, dealing with copiers at the same time. I think there's very few circumstances in the investing world similar to what a PI does in terms of managing money, as there are on eToro, where every single day your score let's say, is updated, and people can, when you invest in a hedge fund, you look at it every day, and you cannot withdraw money on the same day, which I think is, it's a great product that eToro have come up with. By all means, I think it's a really fantastic product, but it may induce a lot of copyists to looking at it in a very short-term way, and I don't think if you're copying somebody, unless you should be looking at it in a short-term way. Even if you're copying somebody who's more active like me, when people think I'm a day trader, I'm not. You look at the number of trades I do, you might think so, but I'm just shrinking and reducing my positions very often. But I'm not, in and out of a trade making money on that day. That's not my attempt. My attempt is position for a macro perspective. But you still got to be realistic that, you're going to compound returns over time, over the long term. And I think my strategy is probably the best way of achieving that. If you have big drawdowns, mathematically that really can impair your results over time in a big way. And so you want to avoid, on a yearly basis, those big drawdowns.
That brings me on to another question that I always ask at this stage of the chat is about your role within a copier portfolio. But I need to sort of set the scene a bit for that, because I saw somewhere else you talked about how copiers could mix and match other PIs with you, and the other PIs could be more risk takers because you're not a risky proposition, which is interesting because a part of me thinks, look at this guy, Antonio. Oh my God, he's shorting all these positions, and he's more short than long, and he's shorting indices, and he's shorting individual stocks, and he's very active, and that sounds to me like there should be an elevated level of risk with that sort of behavior. But you would argue that it's the opposite.
Yeah, I can see exactly why you're saying that, but I would argue the opposite in the sense that I view buying and holding just because stocks always go up, and I believe in this company, is a lot more risky than trying to position for broader macroeconomic environment that is changing, and trying to position in that not in a way where you're always 100% short or always 100% long, but where you have different sides to the trades and different positions within the portfolio. I mean, I think that's a lot less risky than actually being 100% long, with 90% of that being in tech stocks.
So who would you recommend that people copy alongside you in a copy portfolio?
No, honestly, I have no idea. I don't really spend a huge amount of time looking at what other PIs do. I did at the beginning, obviously, when I was trying to figure out, but I don't really. So I wouldn't know exactly who to recommend.
Well, I don't mean specifically. I mean in generic terms. Like if your cousin was to start copy trading and they wanted to copy you, but they wanted to copy, say, 5 or 6 PIs, what sort of broad brush advice would you give them in terms of, okay, maybe add one guy like this, person like that?
Yeah, the idea of copying a broad, but not too broad, because you want to know what these guys are doing. Portfolio of copiers makes sense, having a bunch, 4 or 5, and following what they do. I think to try and find specialists in what they do. So, for example, like an FX trader who's got a good track record, regardless of the environment. Again, I can't recommend value guys or buy and hold guys because I just don't adhere to that kind of. I don't think that's a good strategy over the long term. I think you've got to be extremely good at value investing. And again, people think that value investing just means buying and holding, and it doesn't. Even value investing, there is an element of timing. There's an element of coming in at a certain point and exiting at another point, because people often think they're value investors and buy and hold forever. And again, there's an entry and there's an exit even there. Even Buffett sells things at times. I hope that's advice which is useful to people.
Let's talk about eToro. If you could change one thing about eToro, what would it be?
One thing. I think as a PI, the tool that I most lack and most require from eToro is a better idea of how the risk score works. At the end of the day, it must be a mathematical formula which updates whenever you change a position. As PIs who have to adhere to that limit, and work within those boundaries, why we can't have that as a tool to understand where we are and how that works in more detail. I think that's probably would be the most useful thing. And then it's a great platform, but obviously there's always things which can be improved.
On the risk score, it's been said previously on this show, PIs would welcome some sort of data field that shows them if they're about to make a certain purchase, how that would impact their risk score, that kind of thing.
Something like that, or something which updates 6.1, 6.2, you're here, you're there, whenever you make, so that you know where you're step stoning as you're changing positions in your portfolio. I think that would be the most useful tool, because it's not so much the max risk is 6 or the max risk is 7. They can set that wherever they judge. But for us, if we have to adhere by that, we should be able to understand it and know where we are exactly. Because the way it is now, you only get the average, and let's say you hit 7 in the first week of the month, then after that, you don't know where you are, really. It becomes very, very difficult, apart from experience and understanding how it works, where you are.
I would have thought in general terms, having a long-short portfolio that is evenly spread amongst longs and shorts, as you have, would be quite a good way of keeping a lid on your risk score.
It is, but then consider that at times it might not be so evenly spread. So consider that things, I think, like in July, got extremely overbought and people thought we were bottoming and everybody was sort of chasing. And at that time, I was significantly short, very few longs. That changed after about 3 weeks. And so in those moments of times when you're pushing it a little bit, you want to know where you are.
Okay, one thing the listener wants to know very much is, what other popular investor would you say you know best on a personal level?
You, the only one I've had a real conversation with. I met a few guys at the eToro conference, but on a personal level, I don't think I know. I don't really know any very well.
Who did you meet at the conference?
I met Anna Rodriguez, I think, and Ralek.
Anna Rodriguez, that's Nightingale or Nintingale?
Yes, that's one. That's the one, yeah.
And friend of the show, Claude Creevy, aka Ralek.
Ralek, yeah. I met Ralek.
You guys are cut from very different cloth, him being a crypto fanatic.
Yeah, we had a bit of a chat about that. It's interesting because I started with crypto as one of the first things I gravitated towards, as evident from my stats when I first came to investing. Luckily, I was able to gravitate away from it as a religion and approach it more as it is the liquidity asset per excellence. It's the asset which will benefit the more from liquidity going in, and it will suffer the most from liquidity coming out of the system.
Here's the final question for you, Antonio Nobile.
Okay.
What's the one question that you wish I would have asked you during this chat that I haven't?
In the notes, did you tell me I was supposed to come up with this? I don't remember. What had you wished? You've been quite thorough. What? Well, we didn't talk about crypto a lot, didn't we? And that's like the thing of the moment. Everybody on eToro loves it, and eToro promotes it quite a lot, and we didn't really discuss that very much. But otherwise, you've been quite thorough.
Well, it's not part of your picture, is it?
No, it's not at the moment, because as a UK-based investor, I can't short it, so I can only be long. Otherwise, you can be sure that it would have been in my portfolio on the short side, and so it's reflected in my portfolio through the proxy shorts, i.e. the stocks, MicroStrategy, Coinbase. As I said, it was the start of my journey, and a lot of people, I think, came to investing through crypto. But there more than anywhere else. The idea that it's you buy, you hold, and it always goes up because it's always going to go up has taken hold more than in many other asset class. And I think there more than anywhere, it's more dangerous than in any other asset class. And it's something I've tried to discuss quite a bit on my page.
Well, you heard it here first, listener. Antonio is not a hodler.
No, definitely not.
But your journey has been very interesting. I mean, like you say, that's where you started off. You look at your eToro journey, started off very up and down, and then you made plenty of money in those last few years, and now you seem to be one of the men of the moment who's doing very well in 2022. And if you keep getting it right the way you have been, then it's a given that you're going to rocket up the PI charts.
Yeah, I mean, I must say I'm very happy with the amount of copies I've got. It's become quite stable. It looks like I have a core amount of copies who now have been with me for about 6 months and sort of trust what I'm doing and are happy to stay invested and add in many cases. That's a good base for me to build on. I'm looking forward to becoming an elite PI soon.
Well, we look forward to tracking your progress as time goes on. I was very much looking forward to talking to you, Antonio, and it hasn't disappointed. It's been very, very interesting. And the very best of luck in the future.
Thank you very much. Look forward to talking to you again at some point, I hope.
Many thanks to Antonio for dropping by. What do you think, listener? Is he the real deal? Is he a flash in the pan? Is he one of the most underrated PIs on eToro? Will he keep getting it right, or will his macro moves come unstuck? As ever, only time will tell. We will be hearing some differing opinions on the market next week, that's for sure. That's all from me. See you on Discord and Facebook. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit-chat. We don't know your individual circumstances, etc., and so forth.